So talk about your most successful product in terms of the real estate environment. For you?
I don't know about specific project. I think it's the way we structure a deal for our firm and our investors is we like to co-GP and JV with groups. We're in the development game, but we're not in the go and title for 2 years game. Our success is protecting our clients and investors' money and our own money. I mean, we throw a lot of money in as well. Coming in with a group that maybe needs a co-GP, we bring our balance sheet, we bring our expertise, we bring our construction. So it mitigates our risk on the equity of coming in later to close the deal. So let's say we're close to permits or something like that, or we'll walk along and show them that. So not specific product for us per se, more kind of the structure.
More the way you put it together. Where geographically do you guys try to stay?
Low tax, high growth states, but everywhere has your specific submarkets. So it's not, hey, all Phoenix is great. No, there's pockets that are crap. Hey, all of Texas is great. No, there's good and bad pockets. It's really, I mean, I'm not smarter than anyone else in this room. I'll just outwork anyone in this room. I'll go, if we're doing a multifamily, I'll go canvas 6 blocks. I'm not going to rely on a third-party management company to tell me what the occupancy is. I'll go out and walk it myself, and I'll be an expert in that submarket.
Yeah, which is interesting because, we hear a lot of these AI conversations, and I get it. But I got to tell you, what was John's comment earlier where he said we go walk the property? We do the same thing. I want to walk the property. I want to talk to the local people. All real estate is local anyway. Doesn't matter what you're buying. It's all local. So you physically have to get on site, make sure that what they say is what works. Makes sense. So Christ, in terms of product line, is there a specific product that y'all stay with?
In terms of asset class? Mainly multifamily and student, all Class A and generally merchant build style investments where we're building, stabilizing, and looking to monetize assets. And we do that in not dissimilar a co-GP structure, which is very advantageous to our investors because they're typically going alongside very institutional in nature developers who are bringing in single check institutional LPs, the likes of DWS, Deutsche Bank, Goldman, and we're coming in alongside the co-GP side, benefiting from getting a portion of development fees, management fees, part of the promote, which ends up generally netting about 550 to 650 basis points higher than the institutional LP that's in the deal. And frankly, it's nice for high net worth investors, RIAs, to get access to these institutional developers and be alongside these institutional LPs.
Okay. Do y'all normally have a specific hold period, or how do you treat the asset?
Right. Obviously, our goal is to optimize a monetization schedule, so it's based very much on timing. It was much easier the past 10 years when rates were zero and the world was flat. In today's environment, we are holding things longer. We also have a value add platform as well as a stabilized light value add platform that I would argue today you could be going out and in 5 years see double-digit returns without taking development risk.
Smart. So Matt, how do you look for deal flow when you're a lender like you are?
It's always with the realtor, right? That's where the rubber meets the road. And as far as product lines, this last couple of years, we picked up a niche position, which we've done in the past, which is we do a soup to nuts service with seller financing, particularly on complex or commercial deals, where we get involved, where we're approaching the real estate community. We're asking them to add the seller financing component to their farm. We're getting deal flow from that. And we're talking to sellers that would have never considered carrying back paper, but they are now because rates have normalized. And so in this environment, whether it's a tax-driven reason or just revenue, or they don't know what to do with the money, they're considering carrying back paper. And so we cover a soup to nuts. We qualify the buyer, borrower. We service the loan. We handle the tax. We track the insurance. We write the loan docs to address any and all tenant issues and components, or if there's any construction. There's a whole litany of issues that can fall on the seller, borrower, seller who's now a principal. And that's been a real strong part of what we're doing these days.
Interesting. Curious before I get to the next question for you, Jack, but how many of you on the stage up here would say that you've seen a lot of distressed property at this point?
Some.
Some?
Definitely a good amount.
Cool.
Yeah, I'd say some, expecting more.
Because of the future loans that you think are going to go into default?
Yep.
Interesting.
I would say not full distress. I'd say semi-distressed. Stuff that's not there. I mean, when I talk to a lot of groups out there that have a war chest of $1 billion looking for the multifamily crash that they've had for a year and a half, you see it a little, but everyone's not jumping in yet. That price isn't there for that distress they're truly looking for.
Right.
Yeah, and I'm not sure if the other panelists would agree, but there is so much dry powder chasing these distressed opportunities that the distressed pricing moves up into non-distressed territory. And the combination of that with the, extend and pretend until infinity is, I think, why we all think we're not seeing as much distress as there should be in this environment.
I also think the banks are still kicking the can down the road. They don't want to deal with that. They're going to do everything they can not to have to go take the property back. So, and you probably see that, Matt.
Fix and flip has been tricky in Southern California. I'm helping a family office out, on their defaults, and they're all in fix and flip. People making the wrong assessment going in, not handling or not being able to mitigate changes in construction costs, and that's what I'm seeing.
If you are a founder, raising capital, developing real estate, or you're an investor, would love for you to get involved in the Family Office Club. I've run this community for 18 years now. We've hosted 300 live events. We have 17 million social media group members and followers. We have the #1 YouTube channel on family offices. We have the #1 most popular podcast on family offices. You can learn more about us and our membership options at familyoffices.com. We have 30 in-person events planned in 2026 and another dozen events this year. Please go to familyoffices.com to learn more.